Hello, this is Bill Scheid from Applied Finance Research, and in this video we'll be looking at the performance of PMA SPY with maximum backtest history. Recently, we had a student ask, is the backtest performance of PMA SPY due to the fact that our backtests start in 2008, and does the performance hold up if we look back further? So let's start off by looking at the results of the backtests that start in 2008 that this student was referring to. On the chart, the green line is for PMA SPY and the blue line is for the S&P 500. And we've got some summary performance data at the bottom. We notice that the system's CAGR is 11% and the return is 522.7, which beats the S&P's CAGR of 10.8 and the return of 500.7. But what really stands out to me is the maximum drawdown. The system had a maximum drawdown of only 26.7%, coming in at half that of the S&P 500's maximum drawdown of 52.3%. And what's interesting to me is that this maximum drawdown of 26.7% is actually less than that of a 60-40 diversified all-world stock bond portfolio, which had a maximum drawdown of 34.7% during this same time period. So you're getting returns that beat the S&P with a drawdown that's about 25% less than that of 60-40. Who doesn't love that? And one metric that's of strong interest to me personally as a trader is return to drawdown ratio, which we have here. I like this one because as traders, as investors, we all want the return, but no one wants the drawdown. So how much return do we get for the drawdowns that we have to tolerate? Here we see that the system has a return to drawdown ratio of 19.6 versus 9.6 for the S&P. So for me, that's an indicator of a huge value add for investing in this system versus doing buy and hold with the S&P, which actually few people can do anyway because not many people can tolerate a 50% drawdown. So back to the question at hand, the student wanted to know, is this outperformance that we see here, is this due to the fact that the system plays excellent defense and the backtest starts off in 2008 when the system did an exceptional job navigating the financial crisis? I think that's a fair question, and let's begin by taking a look at that outperformance during the financial crisis. So here we've got results from the beginning of 2007 to the end of 2009. We noticed that the CAGR is 11.6% for the system with a return of 38.9%, which beats the S&P's negative CAGR of minus 5.7% and loss of 16%. We see that the maximum drawdown of the system is only 9.9%, while the S&P had a maximum drawdown of 55.2% for these 3 years. So instead of losing money in the financial crisis, the system made money, and it did it on less than 1/5 the drawdown of the S&P 500. Also, something I want to point out that's very interesting to me is that the CAGR for these 3 years is 11.6%, which is almost exactly the same as the 11% we saw for the first backtest we looked at, which went from 2007 all the way through 2005. So the system's CAGR was stable and robust during the financial crisis. And we also see that the return to drawdown ratio again shows us a huge value add for this system versus buy and hold with the S&P. So this is the outperformance that the student was referring to. Now, the moment you've been waiting for, let's see if this same excellent, robust performance holds up if we add more time to the backtest. Now what we're looking at is the maximum history available on our current backtest tool, which is etfreplay.com. So we've got December 31st, 2002, all the way until July 31st of 2025. The first thing that pops out to me in these data here is that the CAGR for the system is still stable at 11.0%. To me, that's a sign that the system's performance is robust and it's not due to over-optimization or cherry picking a particularly advantageous backtest period. By the way, because this system only has 2 rules, it would be extremely difficult to over-optimize it anyway. There just aren't enough degrees of freedom to over-optimize it. Now, while the S&P has caught up in terms of CAGR and total return, the system still has a maximum drawdown of less than half of that of the S&P. And when we look at the return to drawdown ratio, we see that the S&P has a return to drawdown ratio of 17.9, while the system comes in at double that, arriving at 35.7. So not only do we see robust, stable performance for the system over time when we add the maximum amount of history that we can, but we also see that the system continues to offer a huge value add over buy and hold with the S&P 500. This is Bill Scheid from Applied Finance Research. Thank you very much for watching and happy trading.